OG CoreTalk is the channel where we break down long, complex interviews into clear, actionable ideas so you can level up your thinking in a fraction of the time. If you want more high-value summaries like this, remember to subscribe and turn on notifications. At the end of this summary, I'll remind you again to subscribe if this breakdown helped you understand investing and Warren Buffett's mindset more deeply. This video is a long CNBC interview with Berkshire Hathaway CEO Warren Buffett, focused on how he thinks about stock markets, crises like the coronavirus outbreak, interest rates, banking, and the future of capitalism. Throughout the conversation, Buffett keeps bringing the discussion back to a few core principles. Think of stocks as real businesses, not lottery tickets, and buy them with a 10 to 30-year mindset, not based on daily headlines. When asked about sharp market drops due to virus fears, Buffett acknowledges that business activity can slow down and some companies will be hit. But he insists that the real question is whether long-term earnings power has changed. If you believe American business will be worth more in 20 or 30 years, then lower prices are an opportunity, not a disaster. He warns that nobody can reliably predict short-term market moves and that trying to time crashes or rallies is a losing game. Buffett also stresses how powerful compounding is when you stay invested over decades. He references historical examples like General Motors in the 1930s and books that first laid out the math of compound returns, arguing that retained earnings reinvested over time are what make equities so compelling versus fixed income assets. Stocks versus bonds and today's strange interest rate world. A big part of the discussion contrasts stocks with bonds in a world of ultra-low or even negative interest rates. Buffett explains that historically, bonds looked safer in deflationary eras while stocks outperformed in inflationary periods. But today's environment is unusual because long-term bond yields are extremely low. He sketches three basic choices for investors: short-term cash, long-term bonds, or long-term stocks. With many bonds yielding 2% or less, he questions the logic of locking in tiny returns for decades when you can buy pieces of productive businesses. Still, he cautions that stocks are not always better than bonds at any price. If you pay 50 times earnings for a no-growth business, the math doesn't work. Buffett calls the current interest rate environment unprecedented, noting that economists like Keynes or Adam Smith never imagined trillions in negative-yielding debt. Low rates, he says, have pushed asset prices up across the board since 2008 and created big challenges for insurers and investors who now feel tempted to reach for yield by taking more risk than they understand. His advice is to adjust consumption to your income instead of chasing dangerous returns. Berkshire Hathaway, cash, structure, and buybacks. The interview then shifts to Berkshire itself. Buffett describes Berkshire as a collection of real operating businesses plus a large portfolio of stocks, all sitting on significant cash reserves. He explains that Berkshire keeps a lot of cash not because he loves cash as an investment, but because they must always be able to pay insurance claims and survive any crisis without depending on banks or markets. He walks through Berkshire's decentralized structure. Operating companies like the BNSF Railroad or Geico are run by their own managers who make everyday decisions without calling Omaha for permission. Buffett's main jobs are capital allocation and choosing the right people, not micromanaging operations. This setup lets Berkshire move capital between subsidiaries tax efficiently and avoid the bureaucracy and fees that come with constant Wall Street deals. Buffett also addresses buybacks. He says Berkshire will only repurchase shares when he and Charlie Munger believe the stock is trading below intrinsic value. And he even invites large shareholders to call if they want to sell big blocks directly. At the same time, he acknowledges how hard it is for a huge company like Berkshire to move the needle with buybacks. Even billions in repurchases can represent only a small percentage of the market cap. Airlines, banks, and specific holdings. On sector-specific questions, Buffett talks about airlines and banks. He notes that airlines are highly sensitive to economic conditions, fuel prices, and even events like pandemics, but he still sees long-term potential if they are managed sensibly. Berkshire owns several major U.S. airlines, with Delta being one of the larger positions at the time of the interview. Discussing banks, he argues that well-run commercial banks earning 12 to 16% on tangible equity are attractive businesses compared with bonds. However, he warns that banks have a history of doing dumb things, and he highlights Wells Fargo as a cautionary tale where flawed incentive systems led to fake accounts, scandals, and damage to shareholders. Buffett emphasizes that problems in companies should be confronted immediately, not allowed to fester. He also explains that Berkshire sometimes trims positions, like Wells Fargo, to stay under regulatory thresholds, such as 10% ownership, not just because of scandals. Overall, he remains constructive on the big U.S. banking system, but he insists that discipline and risk management are non-negotiable. COVID-19, pandemics, and market fear. A sizable part of the interview is about the coronavirus outbreak and how pandemics affect markets and businesses. Buffett points to real-world examples like Dairy Queen stores in China closing and Apple facing supply chain disruptions, acknowledging that earnings will be hit in the short run. He also notes big drops in Asian and European markets and widespread travel disruptions and event cancellations. However, he frames pandemics as one of many unpredictable shocks investors must accept. He draws parallels to the 1918 flu and other black swan events, arguing that while fear is understandable, long-term investors should not abandon equities simply because of scary headlines. If you own sound businesses and don't have to sell, a market sell-off can be a gift. Buffett underscores that you should not base your vote or your investment decisions purely on predictions of how markets will react to any single event, whether a virus or a political outcome. He returns again and again to the theme that markets are noisy in the short term, but highly rewarding for patient, rational owners of productive assets. Politics, capitalism, and inequality. Later, the interview touches on politics, capitalism, and inequality. Buffett identifies as a Democrat, but says he's voted across party lines and considers himself a committed capitalist who still cares deeply about people left behind by the system. He supports ideas like expanding the earned income tax credit to boost incomes for working families, rather than radical overhauls that might damage economic growth. On politicians, such as Michael Bloomberg and Bernie Sanders, he indicates he might vote for Bloomberg while disagreeing with some of Sanders's proposals, like giving workers 20% ownership across the board. In Buffett's view, capitalism has produced unprecedented improvements in living standards, and reform should focus on sharing the gains more fairly without killing the golden goose. On corporate governance, he discusses board diversity and independence. Buffett is skeptical of calling highly paid directors independent when their lifestyle might depend on a board seat, which creates subtle pressure to keep CEOs happy. He argues that integrity, competence, and genuine willingness to challenge management matter more than box-ticking around independence. Apple, technology, and what Berkshire will look like after Buffett. The conversation also covers Berkshire's large position in Apple. Buffett describes Apple less as a tech company and more as a consumer products business with huge brand loyalty and a device that has become deeply embedded in people's lives. He admits that he doesn't use all of his phone's features himself, but he recognizes its importance to hundreds of millions of users. He explains that despite short-term hits from things like COVID-19, he's focused on Apple's long-term earning power and ecosystem, not quarterly numbers. Buffett also touches on size as a constraint. Berkshire is so big that even strong performance can look underwhelming versus the S&P 500, and he does not expect Berkshire stock to be a top performer every year going forward. On succession, he stresses that Berkshire is designed to outlive him. The company has multiple capable managers and a culture of disciplined capital allocation that should persist after his death. Much of his wealth is earmarked for philanthropy, but will remain in Berkshire shares so that compounding can continue working for charitable causes over time. Crypto, sustainability, and final reflections. Near the end, Buffett is asked about cryptocurrencies and sustainability. After a high-profile meeting with crypto advocates like Justin Sun, his view on Bitcoin has not changed. He sees it as an asset without intrinsic productive value that depends entirely on finding a future buyer at a higher price. That doesn't mean people can't make money trading it, but he contrasts it with businesses that generate cash flows. On sustainability and ESG, he acknowledges that being socially responsible is important, but says his own investment decisions are still driven mainly by business fundamentals and price. He is cautious about turning investing into a political tool, preferring clear, shareholder-focused decision-making. In closing, the interview shows Buffett as a blend of optimism and realism, deeply confident in the long-term prospects of American business, wary of fads and leverage, and committed to simple rules: buy good businesses at sensible prices, let compounding work, keep plenty of liquidity, and stay calm when others are panicking. It's both a masterclass in investing philosophy and a snapshot of how one of the world's most famous investors thinks about markets in the middle of a global scare. If this OG CoreTalk summary helped you save time and better understand Warren Buffett's mindset, don't forget to subscribe to the channel, like the video, and share it with someone who needs a clearer, calmer approach to investing.